Most people think investing is about picking the next hot stock. Benjamin Graham says that's exactly how you lose money. This book, The Intelligent Investor, isn't about getting rich fast. It's about not getting poor. And that's why Warren Buffett once called it by far the best book on investing ever written. Not because it's exciting, but because it works. Imagine this. Two investors buy the same stock. The market crashes. One panics and sells at the bottom. The other calmly buys more. Years later, one is broke. The other is wealthy. Same stock, same market, completely different outcome. What made the difference? Not intelligence, not insider information, not luck. It was behavior. Graham's core message is brutally simple. The biggest enemy of the investor is not the market. It's himself, fear, greed, overconfidence, the emotional roller coaster that turns rational people into reckless gamblers. That's why this book doesn't start with charts or formulas. It starts with mindset. Graham draws a clear line between investing and speculation. Investing is disciplined, patient, and rooted in facts. Speculation is emotional, reactive, and driven by stories. Wall Street loves to blur that line because confusion makes them money. Clarity makes you money. You'll meet one of the most important characters in all of finance, Mr. Market. He shows up every day, offering to buy or sell your stocks at wildly different prices. Sometimes euphoric, sometimes depressed. Graham teaches you a radical idea. You don't have to listen to him. You can use his mood swings to your advantage instead of letting them control you. Then comes the concept that quietly built the fortunes of generations of investors: margin of safety. It's the idea of buying assets for far less than they're worth, leaving room for mistakes, bad luck, and uncertainty. In a world obsessed with predictions, Graham focuses on protection. This book also destroys the myth that you need to be a genius to succeed in investing. Graham argues the opposite. Simple strategies, executed consistently, beat complex strategies driven by ego. The defensive investor who avoids big mistakes often outperforms the aggressive one chasing brilliance. And here's the uncomfortable truth. If you follow Graham's principles, you'll often look wrong in the short term. You'll feel boring. You'll miss hype. You'll be ignored at parties. But over time, you'll survive crashes. You'll avoid disasters. And quietly, almost unfairly, you'll win. This isn't a book that promises excitement. It promises something far more valuable: long-term financial survival and independence. And in the next few minutes, I'll break down the timeless lessons from The Intelligent Investor and show you how to apply them in today's market, even if you're starting with nothing. Investment versus speculation. Results to be expected by the intelligent investor. In Chapter 1, Benjamin Graham establishes the most important foundation of the entire book: the clear distinction between investment and speculation. According to Graham, most people lose money in the market not because markets are unpredictable, but because they confuse these two activities. Graham defines investment as an operation that, after thorough analysis, promises safety of principal and an adequate return. Any activity that does not meet these standards is speculation. This definition is critical because it shifts the focus away from excitement, predictions, and short-term price movements and toward discipline, analysis, and risk control. One of Graham's key warnings is that speculation itself is not inherently wrong. Problems arise when speculation is disguised as investment. Investors convince themselves they are being rational and long-term, when in reality they are chasing price momentum, stories, or popular trends. Graham emphasizes that intelligent investors must always know which role they are playing, investor or speculator, and never mix the two without awareness. The chapter also challenges the idea that higher returns automatically come from higher intelligence or complexity. Graham explains that results depend more on behavior than brilliance. Many investors with strong analytical skills still perform poorly because they lack emotional discipline. Fear during market declines and greed during market booms lead to bad decisions. Regardless of knowledge level, Graham introduces the concept of the intelligent investor not as someone with a high IQ, but as someone with patience, discipline, and a long-term mindset. Intelligence in investing is largely emotional and psychological. The intelligent investor resists the urge to follow the crowd, avoids overconfidence, and remains focused on fundamental value rather than market noise. Another major point in Chapter 1 is the historical context of market performance. Graham discusses how long-term stock returns have generally been positive, but he strongly cautions against assuming that past performance guarantees future results. Investors who blindly extrapolate recent gains into the future are engaging in speculation, not investment. Graham also highlights the role of inflation and economic cycles, noting that investment decisions must consider real returns, not just nominal gains. A portfolio that grows in dollar terms but loses purchasing power is not truly successful. This reinforces the need for thoughtful asset allocation and conservative assumptions. Importantly, Graham rejects the idea that successful investing requires constant action. Frequent trading, prediction, and reaction often reduce returns rather than enhance them. Instead, intelligent investing emphasizes selectivity, diversification, and long holding periods. Doing less, but doing it correctly, is often more effective than doing more. The chapter concludes with a subtle but powerful message. The market does not reward effort, intelligence, or confidence. It rewards correct principles applied consistently over time. Investors who accept this reality can avoid many common mistakes that destroy long-term wealth. In summary, Chapter 1 sets the philosophical framework for the entire book. It teaches that investing is not about beating others, predicting markets, or finding excitement. It is about protecting capital, achieving reasonable returns, and maintaining emotional control. Everything that follows in The Intelligent Investor builds on this distinction between disciplined investment and dangerous speculation. For anyone approaching the market, Graham's message is clear. Before asking what to buy, you must first understand how and why you are investing. The investor and inflation. In Chapter 2, Benjamin Graham addresses a concern that dominates almost every generation of investors: inflation. Specifically, he examines whether common stocks truly protect investors against the loss of purchasing power, and how inflation should influence long-term investment decisions. Graham begins by acknowledging that inflation is a real and serious threat. When prices rise over time, cash loses value, and fixed-income investments such as bonds can deliver returns that are inadequate in real terms. However, Graham immediately warns against overreacting to inflation fears, which often leads investors to abandon discipline and overpay for assets believed to be inflation-proof. One of the central questions of the chapter is whether stocks are a reliable hedge against inflation. Graham analyzes historical data and finds that, over long periods, common stocks have generally provided returns that exceed inflation. However, he strongly emphasizes that this relationship is neither automatic nor guaranteed. Stocks do not protect against inflation simply because prices are rising. They do so only when corporate earnings and dividends grow at a sufficient pace. Graham criticizes the widespread assumption that stocks will always outperform bonds. During inflationary periods, he explains that high inflation often leads to higher interest rates, which can reduce stock valuations. In such environments, investors may demand higher returns, pushing down stock prices even if company earnings increase. This means inflation can hurt stocks in the short to medium term, especially when markets have already priced in optimistic expectations. Another key point in this chapter is the danger of paying too much for growth. During periods of inflation anxiety, investors tend to chase companies perceived as strong growth businesses, assuming that future earnings will offset rising prices. Graham argues that this mindset often results in speculative behavior, where investors accept low earnings yields and high valuations. When growth fails to materialize as expected, real returns suffer. Graham also evaluates alternative assets often promoted as inflation hedges, such as commodities, real assets, and businesses with pricing power. While these assets can sometimes perform well during inflation, Graham maintains that no asset class provides perfect protection. The intelligent investor should therefore avoid concentrating excessively in any single strategy, based solely on inflation forecasts. Importantly, Graham reinforces the idea that inflation should be managed through asset allocation, not prediction. Instead of trying to guess future inflation rates, investors should build portfolios that are resilient across different economic environments. This includes diversification between stocks and bonds, careful selection of securities, and maintaining conservative assumptions about future returns. Graham also discusses the role of dividends as a partial inflation buffer. Companies that consistently pay and increase dividends can help investors maintain purchasing power over time. However, he cautions that dividend reliability matters more than dividend size. Chasing high yields without regard to financial stability exposes investors to significant risk. A critical takeaway from Chapter 2 is Graham's skepticism toward economic forecasting. He argues that investors who restructure their entire portfolios based on inflation predictions are engaging in speculation. Inflation is only one variable among many, and markets often adjust in ways that make simple cause and effect assumptions unreliable. The chapter concludes by reinforcing Graham's broader philosophy. Intelligent investing is not about eliminating all risks, including inflation, but about avoiding uncompensated risk, overpaying for assets, abandoning diversification, or relying on optimistic assumptions about future growth are far more dangerous than inflation itself. In summary, Chapter 2 teaches that inflation is a legitimate concern, but it should not dominate investment strategy. Stocks can provide long-term protection against inflation, but only when purchased at reasonable prices and held with discipline. The intelligent investor focuses on valuation, diversification, and real returns, rather than reacting emotionally to economic headlines. A century of stock market history. The level of stock prices in early 1972. In Chapter 3, Benjamin Graham examines long-term stock market history to address a critical question. What can investors realistically expect from stocks based on past performance? The purpose of this chapter is not to predict future returns, but to warn investors about the dangers of relying too heavily on historical trends without considering valuation and market conditions. Graham begins by reviewing nearly a century of U.S. stock market data, including periods of strong growth, major crashes, wars, inflation, and economic recovery. His key observation is that while stocks have delivered attractive long-term returns overall, those returns have been highly uneven depending on the starting point. Investors who entered the market at low valuation levels experienced far better outcomes than those who bought during periods of excessive optimism. A major focus of the chapter is the relationship between stock prices and corporate earnings. Graham shows that when stock prices rise much faster than earnings, future returns tend to be lower. Conversely, when prices are depressed relative to earnings, long-term returns improve. This reinforces one of Graham's core principles: price matters. The quality of an investment cannot be separated from the price paid for it. Graham also highlights the danger of market euphoria. In the years leading up to 1972, stock prices had risen significantly, and many investors believed a new era of permanently high valuations had arrived. Graham treats this belief with skepticism. He emphasizes that every historical period of extreme optimism has eventually been followed by disappointment, even if the timing is unpredictable. Another important theme in Chapter 3 is the misuse of averages. Graham explains that quoting long-term average returns can be misleading. If investors ignore starting valuations and economic conditions, averages hide risk. An investor buying at a market peak may experience years of poor or even negative real returns. Despite positive long-term averages, Graham also addresses the concept of reversion to the mean over time. Unusually high profit margins, growth rates, and valuations tend to move back toward historical norms. Investors who assume recent trends will continue indefinitely are engaging in speculation rather than investment. Importantly, Graham does not argue against stock ownership. Instead, he argues against blind optimism. Stocks are productive assets and can build wealth over time, but only when investors remain realistic about expected returns. Graham suggests that future stock returns are likely to be lower when starting valuations are high, regardless of how strong recent performance has been. The chapter reinforces Graham's broader skepticism toward market forecasting. While historical data can provide perspective, It should not be used to justify aggressive assumptions. Graham repeatedly warns that investors tend to extrapolate recent success to far into the future, which leads to overconfidence and excessive risk-taking. In practical terms, Chapter 3 teaches that investors should adjust expectations based on valuation levels, not emotions or headlines. High prices increase risk and reduce future returns. Low prices increase opportunity, but require patience and discipline. In summary, Chapter 3 serves as a reality check. It reminds investors that the stock market is cyclical, valuations matter, and history does not move in straight lines. The intelligent investor studies the past not to predict the future, but to avoid repeating the same mistakes. General portfolio policy, the defensive investor. In Chapter 4, Benjamin Graham introduces one of the most practical and influential frameworks in the book, the distinction between the defensive investor and the enterprising investor. This chapter focuses specifically on the defensive investor and explains how portfolio policy should be designed for investors who prioritize safety, simplicity, and long-term reliability. Graham defines the defensive investor as someone who wants to avoid serious mistakes and does not wish to devote significant time or effort to managing investments. This does not mean the defensive investor lacks intelligence. Rather, they choose a strategy that minimizes the impact of errors, emotional decisions, and market unpredictability. The core recommendation in this chapter is asset allocation between stocks and bonds. Graham argues that the defensive investor should always hold both asset classes. Stocks provide growth and protection against inflation over time, while bonds provide stability and income. Holding only one exposes the investor to unnecessary risk. Graham proposes a simple and disciplined allocation rule. The defensive investor should maintain a stock allocation no lower than 25% and no higher than 75%, with the remainder in bonds. A common default allocation is 50% stocks and 50% bonds. This range-based approach prevents extreme positioning based on market sentiment or forecasts. A key insight is that Graham does not recommend changing allocation based on predictions. Instead, he supports mechanical adjustments. When stock prices rise significantly, stocks become a larger portion of the portfolio and should be trimmed back. When stock prices fall, stocks become undervalued and should be added to. This forces the investor to buy low and sell high without relying on emotion or market timing. Graham strongly criticizes the idea of putting all assets into stocks simply because long-term returns appear attractive. While stocks have historically outperformed bonds over long periods, they are also subject to severe declines. The defensive investor's goal is not maximum return, but adequate return with minimal risk of permanent loss. Another important point in Chapter 4 is Graham's rejection of complexity. He warns defensive investors against advanced strategies, concentrated bets, leverage, or frequent trading. These approaches may appear sophisticated, but often increase risk without improving long-term outcomes. Graham also emphasizes the importance of rebalancing discipline. Without rebalancing, portfolios naturally drift toward higher risk allocations during bull markets and lower risk allocations during bear markets. Exactly the opposite of what intelligent behavior requires. Rebalancing restores balance and enforces rational decision-making. The chapter reinforces Graham's broader philosophy that successful investing is largely about avoiding big mistakes. A simple, diversified portfolio that is consistently maintained will outperform many complex strategies over time, especially after accounting for errors, costs, and emotional decisions. In summary, Chapter 4 provides a clear blueprint for conservative, long-term investing. The defensive investor does not attempt to outsmart the market. Instead, they rely on diversification, balanced allocation, and discipline. By staying within defined limits and resisting emotional extremes, the defensive investor builds a portfolio designed to survive market cycles and deliver steady results over time. This chapter sets the foundation for all later discussions on stock and bond selection and remains one of the most actionable sections of The Intelligent Investor, the defensive investor and common stocks. In Chapter 5, Benjamin Graham narrows his focus to how the defensive investor should approach common stocks. The goal of this chapter is not to teach stock picking in detail, but to establish clear rules and limits that reduce risk and prevent costly mistakes. Graham begins by reaffirming that common stocks are an essential component of a long-term portfolio. Even for conservative investors, stocks provide growth and partial protection against inflation, but they also introduce volatility. The defensive investor must therefore approach stocks with strict discipline, not optimism or excitement. One of Graham's central principles is diversification. He strongly advises against owning a small number of stocks. For the defensive investor, diversification is not optional. It is a core risk control mechanism. Graham suggests holding a broad group of stocks across different industries to reduce the impact of any single business failure. Graham also emphasizes that defensive investors should avoid individual stock speculation. He argues that analyzing companies deeply enough to gain an edge requires time, skill, and emotional control that most investors do not have. As a result, he recommends that defensive investors rely primarily on high-quality, representative stocks rather than attempting to identify exceptional performers. A major recommendation in this chapter is the use of index-style investing, or broadly diversified portfolios that represent the overall market. While index funds were not as common when Graham wrote the book, his logic clearly supports low-cost, diversified exposure to large, established companies. This approach reduces both analytical error and emotional decision-making. Graham outlines several minimum standards for stocks suitable for defensive investors. These include adequate company size, strong financial condition, a long history of dividend payments, stable earnings over time, moderate price-to-earnings and price-to-book ratios. These criteria are designed to filter out speculative businesses and focus on companies with proven durability. Graham is not trying to maximize upside. He is trying to eliminate avoidable risks. Another important warning in Chapter 5 concerns market enthusiasm. Graham notes that during bull markets, even high-quality stocks can become overpriced. Defensive investors must resist the temptation to buy simply because prices are rising or because a company is popular. Overpaying for quality still leads to poor results. Graham also discourages defensive investors from chasing new issues, fashionable industries, or rapid growth stories. These areas attract speculation and often involve excessive expectations. For the defensive investor, reliability is more important than excitement. The chapter reinforces the idea that successful stock investing for defensive investors depends more on process than prediction. By following predefined rules, maintaining diversification, and avoiding emotional decisions, investors can achieve satisfactory results without constant monitoring or complex analysis. In summary, Chapter 5 teaches that common stocks can and should be part of a conservative portfolio, but only under strict conditions. The defensive investor should favor broad diversification, high-quality companies, reasonable valuations, and long-term holding periods. This approach sacrifices the possibility of extraordinary gains in exchange for consistency, safety, and long-term success. Graham's message is clear when it comes to stocks. Defensive investing is about controlling risk first and letting returns follow naturally over time. Portfolio policy for the enterprising investor, negative approach. In Chapter 6, Benjamin Graham shifts attention from the defensive investor to the enterprising investor, beginning with what he calls the negative approach. This chapter explains not what the enterprising investor should actively pursue yet, but what they must avoid in order to achieve superior results. Graham defines the enterprising investor as someone willing to devote time, effort, and analytical discipline to investing, with the goal of earning returns above the market average. However, Graham immediately makes it clear that being enterprising does not mean being aggressive, speculative, or reckless. Without strict standards, the enterprising investor can easily underperform the defensive investor. The first major warning in this chapter concerns high-grade bonds during periods of low yields. Graham argues that buying long-term bonds when interest rates are low exposes investors to significant risk with limited upside. If rates rise, bond prices fall, and the investor may suffer large capital losses. For the enterprising investor, Graham suggests avoiding such bonds unless yields are clearly attractive relative to historical standards. Next, Graham cautions against common stocks with excessive popularity and high valuations. Stocks that are widely admired, heavily promoted, and priced for perfection leave little margin for error. Even strong companies can deliver poor investment results if purchased at inflated prices. Graham stresses that enterprising investors should not assume that quality alone justifies any price. Another area Graham criticizes is new issues and initial public offerings (IPOs). He observes that new offerings are often brought to market during favorable conditions, when investor enthusiasm is high and prices are maximized. Historically, many IPOs perform poorly after issuance. Graham advises enterprising investors to treat new issues with skepticism rather than excitement. Graham also addresses growth stock speculation. While he does not reject growth investing entirely, he warns that investors often overestimate future growth and underestimate risk. Paying high multiples for anticipated growth turns investment into speculation, unless supported by conservative assumptions and a margin of safety. A key concept in Chapter 6 is the danger of institutional thinking. Graham points out that professional investors frequently follow conventional wisdom to avoid standing out, even when valuations are unattractive. The enterprising investor must be willing to differ from the crowd, but only when analysis clearly supports doing so. Graham emphasizes that the negative approach is about risk elimination. By avoiding overpriced securities, unfavorable bond structures, speculative new issues, and popular market fads, the enterprising investor dramatically improves their chances of long-term success. Superior results often come not from brilliance, but from avoiding common and costly errors. The chapter reinforces Graham's belief that investment success is asymmetrical. A small number of bad decisions can erase the benefits of many good ones. Therefore, the enterprising investor's first responsibility is to protect capital by saying no more often than yes. In summary, Chapter 6 teaches that enterprising investing begins with discipline and restraint. Before seeking opportunities, investors must eliminate areas where the odds are stacked against them. Avoiding overpriced assets, low-yield bonds, speculative growth stories, and fashionable issues creates a solid foundation for intelligent, active investing. This chapter sets the stage for the next phase of the book, where Graham explains the positive strategies that enterprising investors can use. Once major risks have been systematically removed, portfolio policy for the enterprising investor, the positive side. In Chapter 7, Benjamin Graham moves from what the enterprising investor should avoid to what they can actively do to achieve results superior to the average investor. This chapter outlines several legitimate investment strategies that require extra effort, discipline, and analysis, but offer the potential for higher returns if executed correctly. Graham begins by reminding readers that enterprising investing is not about frequent trading or bold predictions. It is about systematic exploitation of market inefficiencies. While maintaining strict standards of safety, the enterprising investor must be willing to work harder than the defensive investor, but also remain grounded in conservative principles. One of the first strategies Graham discusses is investing in large, well-known companies that are temporarily undervalued. These are businesses with established records, solid finances, and long operating histories, whose stock prices have declined due to short-term problems, pessimism, or market overreaction. Graham argues that when such companies are purchased at sufficiently low prices, they offer both safety and opportunity. Another important approach is investing in bargain issues, also known as value stocks. These are securities selling below conservative estimates of their intrinsic value, often measured by earnings power, asset value, or liquidation value. Graham emphasizes that the margin of safety is essential. The discount must be large enough to protect against analytical errors and unexpected developments. Graham also introduces strategies involving secondary companies, smaller firms that are not market leaders but are financially sound and undervalued. While these investments carry higher business risk, they often offer greater pricing inefficiencies because they receive less attention from institutional investors. Proper diversification is especially important when using this strategy. A key theme in Chapter 7 is selectivity. Unlike the defensive investor, the enterprising investor does not need to own the entire market. Instead, they focus on a limited number of opportunities that meet strict criteria. However, Graham warns that concentration must be justified by analysis, not confidence. Graham addresses the concept of special situations, such as mergers, liquidations, reorganizations, and spin-offs. These investments can offer attractive returns because outcomes depend more on specific events than general market movements. However, they also require specialized knowledge and careful evaluation. Graham stresses that these opportunities are not suitable for all investors. Throughout the chapter, Graham reinforces the importance of emotional discipline. Enterprising strategies often require buying when sentiment is negative and selling when optimism returns. This behavior is psychologically difficult, even for experienced investors. Without emotional control, active strategies quickly become speculative. Graham also cautions that enterprising investing is not scalable without limits. As more investors adopt similar strategies, excess returns diminish. This is why superior performance requires both skill and patience, and why not every investor should attempt to outperform the market. In summary, Chapter 7 explains that superior investment results are achievable, but only through careful analysis, conservative valuation, diversification, and discipline. The enterprising investor earns higher returns not by forecasting the future, but by exploiting mispricing created by fear, neglect, and market inefficiency. This chapter completes Graham's framework for active investing and makes one point unmistakably clear: higher returns are available, but only to investors willing to earn them through work, restraint, and adherence to sound principles. The investor and market fluctuations. In Chapter 8, Benjamin Graham explains how investors should think about market price movements and how to respond to them intelligently. This chapter is one of the most important in the book because it addresses the psychological side of investing, specifically how emotions triggered by price fluctuations lead to poor decisions. Graham begins by stating that market fluctuations are normal and unavoidable. Prices do not move in straight lines, and volatility is not a sign that something is wrong. The mistake most investors make is treating price changes as instructions rather than information. Rising prices create excitement and overconfidence, while falling prices trigger fear and panic. To illustrate this idea, Graham introduces the famous metaphor of Mr. Market. Mr. Market is an emotional partner who shows up every day offering to buy or sell shares at different prices. Some days he is optimistic and overvalues stocks. Other days he is depressed and undervalues them. Graham's key lesson is that the investor is free to ignore Mr. Market entirely unless his prices are advantageous. Graham emphasizes that price volatility is not risk by itself. Risk comes from the possibility of permanent loss, not from temporary price declines. Investors who confuse volatility with risk often sell at the worst possible times. Intelligent investors view market declines as potential opportunities rather than threats, provided the underlying business remains sound. A central theme of the chapter is the importance of intrinsic value. Graham argues that investors should form their own estimate of what a business is worth. Based on fundamentals, market prices should then be compared to this value. When prices fall well below intrinsic value, buying becomes attractive. When prices rise far above intrinsic value, caution or selling is appropriate. Graham warns strongly against using the market as a guide for what to do, following market trends, reacting to headlines, or relying on price momentum turns investing into speculation. Instead, the market should serve as a reference point, not a decision maker. The chapter also reinforces the role of emotional discipline. Graham notes that investors are their own worst enemies because they allow emotions to override analysis. Success depends less on intelligence and more on temperament. The ability to remain rational during periods of extreme optimism or pessimism is a defining trait of the intelligent investor. Graham discusses how both defensive and enterprising investors can use market fluctuations to their advantage. Defensive investors benefit through disciplined rebalancing, buying more stocks when prices are low and reducing exposure when prices are high. Enterprising investors can exploit larger mispricings by selectively buying undervalued securities. Another important point is Graham's rejection of market timing. He argues that consistently predicting short-term market movements is unrealistic. Attempting to do so increases transaction costs, taxes, and emotional stress, while rarely improving results. In summary, Chapter 8 teaches that the market's greatest value is not in guidance, but in opportunity. Intelligent investors do not fear market fluctuations, they expect them. By focusing on value, maintaining discipline, and refusing to be controlled by emotion, investors can turn volatility from an enemy into an ally. This chapter reinforces one of Graham's most enduring lessons. The market exists to serve you, not to instruct you. Investing in investment funds. In Chapter 9, Benjamin Graham evaluates investment funds, focusing primarily on mutual funds, and explains how individual investors should assess and use them intelligently. The chapter is especially relevant for investors who prefer professional management but want to avoid common structural and behavioral pitfalls. Graham begins by recognizing the appeal of investment funds. For many investors, funds offer diversification, convenience, and professional oversight that would be difficult to achieve independently. However, Graham makes it clear that these advantages do not guarantee superior results. Investors must still apply judgment and discipline when selecting funds. A major theme of the chapter is performance realism. Graham analyzes historical data and shows that most professionally managed funds fail to outperform the general market over long periods, especially after accounting for fees and expenses. This leads to one of his most important conclusions. Past performance is not a reliable predictor of future results. Graham criticizes the marketing practices of fund companies that highlight short-term success, while ignoring long-term consistency. Funds often rise to the top of performance rankings during favorable market conditions, only to underperform later when conditions change. Investors who chase performance typically buy after strong gains and sell after disappointing results, locking in poor outcomes. Another key focus is cost structure. Graham emphasizes that management fees, sales loads, and operating expenses have a direct and permanent impact on investor returns. Even small differences in annual costs compound significantly over time. For the defensive investor in particular, minimizing costs is essential. Graham also discusses the problem of excessive trading within funds. High portfolio turnover increases transaction costs and tax liabilities, reducing net returns. Funds that trade frequently may appear active and sophisticated, but this activity often benefits the fund manager more than the investor. Importantly, Graham draws a distinction between investment funds as a tool and blind reliance on professional judgment. Delegating decisions to a fund manager does not eliminate risk or the need for investor understanding. Investors must still evaluate whether a fund's strategy aligns with sound investment principles. Graham expresses cautious approval of funds that follow conservative, diversified, and low-cost approaches. While index funds were not yet dominant when Graham wrote the book, his analysis strongly supports passive strategies that track the overall market and avoid unnecessary expenses and speculation. The chapter also addresses investor behavior within funds. Graham notes that many investors misuse funds by switching frequently, reacting to short-term results, or allocating capital based on emotion rather than logic. These behaviors undermine the benefits that funds are supposed to provide. Graham warns against specialized and thematic funds that concentrate on narrow industries or strategies. While such funds may perform well temporarily, they introduce additional risk and often reflect speculative enthusiasm rather than sound investment logic. In summary, Chapter 9 teaches that investment funds can be effective tools for building wealth, but only when used correctly. The intelligent investor should favor low costs, broad diversification, long-term consistency, and disciplined behavior. Relying on star managers, recent performance, or complex strategies increases risk without reliably improving results. Graham's conclusion is clear. investment funds do not remove the need for intelligence and discipline. They simply change where mistakes are likely to occur. The investor and his advisors. In Chapter 10, Benjamin Graham examines the relationship between the investor and financial advisors, including brokers, analysts, and investment counselors. The central question of this chapter is not whether advisors are useful, but how much trust and responsibility an investor should delegate without compromising intelligent decision-making. Graham begins by acknowledging that many investors lack the time, interest, or technical knowledge to manage their own portfolios. For these individuals, professional advice can be valuable. However, Graham immediately warns that hiring an advisor does not remove the need for judgment. Investors remain responsible for understanding the general principles guiding their investments. A key distinction in this chapter is between investment advice and salesmanship. Graham points out that many advisors are compensated through commissions, which can create conflicts of interest. Brokers may recommend frequent trading, new issues, or complex products not because they are superior investments, but because they generate higher fees. Intelligent investors must recognize these incentives and remain skeptical of recommendations that emphasize activity over long-term value. Graham stresses that advisors should be evaluated based on process, not promises. Any advisor claiming the ability to consistently outperform the market, predict market movements, or avoid all losses is likely overstating their capabilities. Graham argues that honest and competent advisors focus on diversification, valuation discipline, and risk control rather than bold forecasts. Another major theme is expectation management. Investors often hire advisors during periods of poor performance, expecting immediate improvement. Graham cautions that even sound strategies can experience temporary underperformance. Judging advisors based on short-term results leads to frequent switching, higher costs, and worse outcomes. Graham also addresses the role of investment counseling services, which typically charge a fixed fee rather than commissions. While this structure reduces some conflicts of interest, Graham notes that it does not guarantee superior judgment. The quality of advice still depends on adherence to conservative investment principles. Importantly, Graham argues that advisors should not encourage investors to take more risk than they can emotionally tolerate. A strategy that is theoretically sound but causes anxiety, panic, or abandonment during market declines is unsuitable. Intelligent advice aligns with both financial goals and psychological limits. Graham emphasizes that the best advisors help investors avoid major mistakes rather than chase exceptional returns. Preventing overtrading, excessive speculation, and emotional reactions often adds more value than attempting to find winning stocks. The chapter also reinforces Graham's belief that simplicity is a virtue. If an investor's situation calls for a defensive approach, advisors should recommend simple, diversified portfolios rather than complex strategies designed to appear sophisticated. In summary, Chapter 10 teaches that advisors can be useful, but they are not substitutes for investor responsibility. The intelligent investor understands basic principles, maintains realistic expectations, and evaluates advice critically. Trust should be earned through discipline, transparency, and alignment with long-term goals, not through confidence, complexity, or promises of superior performance. Graham's core message is clear. No advisor can protect an investor from poor judgment, except the investor himself. Security analysis for the lay investor, general approach. In Chapter 11, Benjamin Graham introduces the basic framework of security analysis intended for the ordinary investor, not professional analysts. The goal of this chapter is not to turn readers into experts, but to show how simple, disciplined analysis can significantly improve investment decisions and reduce risk. Graham begins by clarifying the purpose of security analysis. The objective is not to predict short-term stock price movements, but to determine whether a security is fundamentally sound and reasonably priced. Analysis should focus on protection against loss rather than the pursuit of extraordinary gains. A central principle in this chapter is the distinction between qualitative and quantitative factors. Graham argues that while business stories, management reputation, and industry trends may be interesting, they are unreliable unless supported by solid financial data. For the lay investor, numbers matter more than narratives. Graham outlines the key financial elements investors should examine. These include earnings record over a long period, financial strength, particularly balance sheet stability, dividend history and consistency, capital structure and debt levels. He emphasizes that analysis should be based on multi-year averages, not single-year results. Temporary setbacks or unusually strong years can distort judgment. A long earnings record provides better insight into a company's true earning power. Another major point in Chapter 11 is Graham's skepticism toward earnings forecasts. He argues that projections of future growth are inherently uncertain and often reflect optimism rather than reality. While some estimate of future earnings is unavoidable, Graham urges investors to remain conservative and avoid relying heavily on precise forecasts. Graham also discusses valuation, particularly the relationship between price and earnings. He warns against paying high prices for expected growth, as this eliminates the margin of safety. Even strong companies can be poor investments if purchased at excessive valuations. The chapter reinforces the importance of the margin of safety, even at this early stage of analysis. Graham argues that investors should build protection into their decisions by demanding favorable prices relative to earnings, assets, and financial stability. This margin protects against errors in analysis, economic downturns, and unexpected business problems. Graham cautions lay investors against attempting overly detailed or technical analysis. Complex models, precise forecasts, and advanced accounting adjustments can create a false sense of confidence. The intelligent investor focuses on broad, reliable indicators rather than fine-tuned predictions. Another key theme is consistency of method. Graham encourages investors to apply the same standards across all investments, rather than adjusting criteria to justify attractive opportunities. Flexible standards often lead to speculative decisions disguised as analysis. Importantly, Graham notes that security analysis is most useful when combined with sound portfolio policy. Even careful analysis cannot eliminate all risk. Diversification remains essential, especially for non-professional investors. In summary, Chapter 11 teaches that effective security analysis for the lay investor should be simple, conservative, and disciplined. The investor's task is not to outguess the market, but to identify sound businesses, avoid weak financial structures, and insist on reasonable prices. Graham's core message is clear: basic analysis, applied consistently, is far more valuable than complex analysis applied selectively. Things to consider about per-share earnings. In Chapter 12, Benjamin Graham focuses on a metric that investors rely on heavily, but often misunderstand: per-share earnings EPS. Graham's objective in this chapter is to explain why reported earnings figures can be misleading, and how intelligent investors should interpret them more carefully. Graham begins by acknowledging that earnings per share are central to valuation, stock prices, price-to-earnings ratios, and growth expectations all depend on earnings figures. However, Graham immediately warns that EPS is not a precise or objective number. It is influenced by accounting choices, capital structure, and managerial decisions, which can distort the true earning power of a business. One of the first issues Graham addresses is the difference between reported earnings and actual earning power. Companies may include non-recurring gains, such as asset sales or tax benefits, which inflate earnings in a given year. Conversely, temporary losses or write-downs may depress earnings even though long-term business prospects remain intact. Graham advises investors to focus on normalized earnings, using multi-year averages rather than single-year results. Another key topic in this chapter is dilution. Graham explains that earnings per share can be misleading if investors ignore the impact of stock options, convertible securities, warrants, and new share issuance. Even if total earnings grow, earnings per share may stagnate or decline if the number of shares increases. Intelligent investors must always examine earnings in relation to the number of shares outstanding, not just total profit figures. Graham also discusses capital structure complexity. Companies with convertible bonds or preferred stock may report earnings figures that overstate what common shareholders are truly entitled to. Graham urges investors to read footnotes and disclosures carefully to understand how earnings are allocated. Another major warning concerns earnings smoothing and accounting flexibility. Management has discretion in recognizing revenue, depreciation, and expenses. While not necessarily fraudulent, these practices can make earnings appear more stable or more attractive than the underlying business reality. Graham emphasizes that investors should be skeptical of companies that show unusually smooth or rapidly growing earnings without clear economic justification. Graham also critiques the excessive emphasis on short-term earnings growth. Investors and analysts often extrapolate recent growth far into the future, assigning high valuations based on optimistic assumptions. Graham argues that growth should be treated conservatively and validated by long-term trends, not short-term momentum. The chapter reinforces the importance of long-term earnings records. Graham suggests examining at least 7 to 10 years of earnings data to assess stability and resilience across economic cycles. A company with modest but consistent earnings is often a safer investment than one with spectacular but erratic results. Graham also notes that earnings should always be evaluated in combination with price. Even accurate earnings figures do not justify overpaying. A strong earnings record does not eliminate the need for a margin of safety. In summary, Chapter 12 teaches that per-share earnings are useful but dangerous when taken at face value. Intelligent investors must adjust for one-time items, dilution, accounting distortions, and business cycles. The goal is not precision, but conservatism and realism. Graham's message is clear. Earnings are an input to analysis, not a conclusion. Only when earnings are examined carefully and skeptically can they support intelligent investment decisions. A comparison of for listed companies. In Chapter 13, Benjamin Graham demonstrates how security analysis works in practice by comparing for publicly listed companies. The purpose of this chapter is not to identify winning stocks, but to show how investor perception, valuation, and fundamentals can differ sharply, and why price matters more than popularity. Graham begins by explaining that all four companies appear respectable on the surface. They are established businesses with long operating histories, and each has attracted investor interest at different times. However, Graham's analysis reveals that market enthusiasm often focuses on earnings growth and reputation, while ignoring valuation and financial stability. The central lesson of this chapter is that investors frequently overpay for growth. Some of the companies in Graham's comparison had strong recent earnings increases and optimistic future expectations. As a result, their stocks traded at high price-to-earnings ratios. Graham shows that these high valuations left little margin for error. Even minor disappointments in growth could lead to large declines in stock price. In contrast, other companies in the comparison had slower growth, less excitement, or temporary setbacks. These companies were priced more conservatively, often at lower multiples of earnings and closer to asset value. Graham argues that despite appearing less attractive, these stocks often offered better investment prospects because their prices already reflected pessimism. Graham analyzes several key factors for each company, including earnings history and stability, dividend record, financial condition and debt levels, market price relative to earnings and assets. By applying consistent standards, Graham demonstrates how two companies with similar business quality can represent vastly different investment risks depending on the price paid. A major takeaway from this chapter is that market price reflects expectations, not reality. Stocks that are priced for strong growth must continuously deliver exceptional results just to justify their valuation. Meanwhile, stocks priced modestly can produce satisfactory returns even with average performance. Graham also highlights the psychological element of investing. Investors are drawn to companies with exciting narratives, strong recent performance, and positive media coverage. These factors create confidence, but confidence does not equal safety. In fact, widespread optimism often signals higher risk, not lower. Another important point is Graham's emphasis on comparative analysis. Rather than evaluating stocks in isolation, investors should compare similar companies side by side using the same criteria. This approach exposes inconsistencies in market pricing and helps investors avoid emotional bias. Graham does not claim that undervalued companies will always outperform in the short term. Instead, he argues that over time, valuation exerts a powerful influence on returns. Paying too much for quality can lead to disappointing results, while paying reasonable prices for solid businesses increases the probability of success. In summary, Chapter 13 reinforces one of Graham's most important principles: investment results depend not only on business performance, but on the price paid. Superior companies do not automatically make superior investments. Intelligent investors focus on fundamentals and valuation, not popularity or optimism. This chapter serves as a practical reminder that disciplined comparison and conservative pricing are essential tools for avoiding overpayment and achieving sound long-term investment results. Stock selection for the defensive investor. In Chapter 14, Benjamin Graham provides specific, practical rules for how the defensive investor should select common stocks. This chapter translates Graham's philosophy into clear screening standards designed to minimize risk and avoid speculative errors. Graham begins by reiterating that the defensive investor's objective is safety and adequacy, not exceptional performance. Stock selection must therefore rely on objective criteria, not judgment about future growth or market trends. The defensive investor should use rules that can be applied consistently, even by those with limited time and expertise. The first major requirement is adequate size of the enterprise. Graham argues that large, established companies are generally more resilient than smaller firms. Size provides stability, access to capital, and diversification of operations. Smaller companies may offer higher growth potential, but they also introduce greater business risk, which is inappropriate for defensive investors. Next, Graham emphasizes strong financial condition. For industrial companies, this means a current ratio of at least 2-to-1 and long-term debt that does not exceed net current assets. These balance sheet standards ensure that the company can withstand economic stress without threatening shareholder capital. Another key criterion is earnings stability. Graham recommends that defensive investors select companies with a long record of positive earnings, typically over the past 10 years. This requirement filters out businesses with volatile or uncertain profitability and reduces exposure to cyclical or speculative enterprises. Graham also insists on a continuous dividend record. Companies suitable for defensive investors should have paid dividends consistently for at least 20 years. Dividends provide tangible returns and signal financial discipline. A long dividend history also demonstrates management's commitment to shareholders. The chapter then addresses earnings growth. While Graham does not demand rapid growth, he suggests a moderate increase in earnings over time, often defined as at least one-third growth over 10 years. This ensures that the company is not stagnating, while avoiding the risks associated with aggressive growth assumptions. Valuation plays a critical role in Graham's framework. He sets clear limits on acceptable price-to-earnings and price-to-book ratios. Defensive investors should avoid paying excessive prices, even for high-quality companies. Graham introduces a combined valuation rule that restricts the product of the P/E ratio and the price-to-book ratio, reinforcing the principle that quality does not justify overpayment. Throughout the chapter, Graham stresses simplicity and discipline. These criteria are not meant to identify the best-performing stocks, but to exclude dangerous ones. By applying these standards consistently, the defensive investor reduces the likelihood of permanent capital loss. Graham also notes that following these rules naturally leads to diversification, as few companies will meet all criteria at any given time. This further strengthens portfolio safety. In summary, Chapter 14 provides a rule-based stock selection framework for conservative investors. The defensive investor does not rely on forecasts, insider insights, or market timing. Instead, they focus on company size, financial strength, earnings stability, dividend history, moderate growth, and reasonable valuation. Graham's core message is clear. Successful defensive investing is not about intelligence or prediction. It is about discipline, restraint, and refusing to pay too much for safety. Stock selection for the enterprising investor. In Chapter 15, Benjamin Graham builds on the previous chapter by outlining how the enterprising investor should select common stocks. Unlike the defensive investor, the enterprising investor is willing to invest time and effort to identify opportunities that offer returns above the market average. However, Graham makes it clear that higher returns come only through stricter analysis and greater discipline, not through speculation. Graham begins by emphasizing that enterprising stock selection must still be rooted in value and safety. The enterprising investor does not abandon conservative principles. Instead, they apply them more actively. The key difference is selectivity. Enterprising investors concentrate on a smaller number of opportunities that meet demanding criteria, rather than holding a broad market portfolio. One major category Graham discusses is undervalued large companies. These are established businesses with sound financial positions whose stock prices have declined due to temporary problems, unfavorable sentiment, or general market weakness. Graham argues that such companies often provide attractive opportunities because the market overreacts to short-term issues while ignoring long-term earning power. Another important area is secondary companies, which are smaller firms that are not market leaders. Graham notes that these companies are often overlooked by institutional investors, leading to greater pricing inefficiencies. While they carry higher business risk than large companies, careful selection and diversification can make them suitable for enterprising investors seeking higher returns. Graham also revisits the concept of bargain issues, including stocks selling below net current asset value. These securities provide a substantial margin of safety because the market price is backed by tangible assets. Although such opportunities are rare, Graham views them as among the most reliable sources of superior returns when properly diversified. The chapter stresses the importance of quantitative analysis over subjective judgment. Graham advises enterprising investors to rely on measurable criteria such as earnings history, balance sheet strength, and valuation ratios. Predictions about future growth, management brilliance, or industry trends should play a limited role. Graham highlights the necessity of diversification, even for enterprising investors. Concentration increases both potential returns and potential losses. Graham suggests holding a group of enterprising investments rather than betting heavily on a few ideas. This reduces the impact of analytical errors or unexpected developments. Another key point is patience. Enterprising investments often require time for value to be recognized by the market. Short-term underperformance does not mean the analysis was wrong. Investors must be willing to hold positions until the underlying value is realized. Graham also warns against excessive trading. Enterprising investing is not about frequent buying and selling. High turnover increases costs and taxes, reducing net returns. Most of the gains from enterprising strategies come from valuation reversion, not market timing. In summary, Chapter 15 teaches that superior stock selection is possible, but only through careful analysis, conservative valuation, diversification, and emotional discipline. The enterprising investor earns higher returns by buying sound businesses at unfavorable prices, not by chasing growth or excitement. Graham's core message is consistent with the rest of the book. Investment success depends more on discipline and valuation than on intelligence or forecasts. Convertible issues and warrants. In Chapter 16, Benjamin Graham examines convertible securities and warrants, explaining how they function, why investors find them attractive, and why they often carry hidden risks. The purpose of this chapter is to help investors understand these instruments clearly and avoid treating them as safer or more profitable than they truly are. Graham begins by defining convertible securities, which are typically bonds or preferred stocks that can be converted into common shares at a predetermined price. Warrants are similar but usually issued separately, giving the holder the right to purchase common stock at a fixed price over a specified period. Both instruments combine features of debt and equity, which makes them appear flexible and appealing. The main attraction of convertibles and warrants is the promise of participation in stock price appreciation with reduced downside risk. Investors are often drawn to the idea that they can enjoy stock-like upside while being protected by bond-like characteristics. Graham challenges this assumption and argues that this perceived advantage is frequently overstated. A central point in the chapter is that convertibles often offer inferior income and weaker protection compared to straight bonds. To gain the conversion privilege, investors usually accept lower interest rates or dividends. As a result, if the stock fails to rise meaningfully, the investor earns less income than they would have received from a conventional bond. Graham also explains that the conversion feature benefits the issuing company more than the investor. Convertibles allow companies to borrow at lower rates and potentially issue equity later at favorable prices. From the investor's perspective, this often means accepting unfavorable terms and reduced safety in exchange for speculative upside. When discussing warrants, Graham is even more cautious. Warrants provide leverage to rising stock prices, but offer no protection on the downside. If the stock does not exceed the exercise price within the warrant's life, the warrant becomes worthless. Graham classifies warrants as speculative instruments, unsuitable for defensive investors and risky even for enterprising ones. Another important theme in Chapter 16 is valuation confusion. Convertibles and warrants are often difficult to value accurately, which increases the likelihood of mispricing. Investors may focus on potential upside while underestimating the probability of poor outcomes. Complexity, Graham argues, does not create value. It often obscures risk. Graham also warns against purchasing convertibles simply because they are issued by reputable companies. A strong issuer does not eliminate the structural disadvantage of the instrument. Investors must evaluate the terms, yield, and conversion price carefully, rather than relying on brand reputation. The chapter reinforces Graham's broader principle that investment quality depends on structure and price, not novelty. Instruments that appear sophisticated or innovative frequently serve marketing purposes rather than investor interests. In summary, Chapter 16 teaches that convertible issues and warrants should be approached with skepticism. While they may have a role in certain speculative or specialized strategies, they are generally inferior to straightforward bonds or common stocks for most investors. Graham's conclusion is clear. Intelligent investing favors simplicity, transparency, and adequate compensation for risk. When an investment's appeal depends on complex features and optimistic assumptions, the odds are usually tilted against the investor. For extremely instructive case histories, in Chapter 17, Benjamin Graham presents for real-world case studies to illustrate how poor financial practices, excessive optimism, and weak investor discipline can destroy shareholder value. The purpose of this chapter is not historical detail, but risk education. Each case highlights a specific type of mistake that intelligent investors must learn to recognize and avoid. The first case focuses on a company that expanded aggressively during favorable conditions, relying heavily on debt financing. When business conditions deteriorated, the company was unable to service its obligations, leading to severe losses for shareholders. Graham's lesson is clear. High leverage magnifies risk, especially during economic downturns. Investors who ignore balance sheet strength expose themselves to permanent capital loss, even when earnings initially appear strong. The second case examines a business that appeared profitable based on reported earnings, but whose underlying economics were weak. Graham shows how accounting earnings can mask deteriorating fundamentals, particularly when companies rely on optimistic assumptions, deferred costs, or one-time gains. Investors who focus only on income statements without examining cash flow and asset quality are vulnerable to misleading conclusions. Another case highlights the danger of excessive dilution. Graham explains how companies can increase total earnings while reducing earnings per share through frequent issuance of new stock, options, or convertibles. From the shareholder's perspective, ownership value is diluted even if the company grows. Graham reinforces the lesson that investors must evaluate results on a per-share basis, not in aggregate. One of the most important themes in this chapter is management behavior. Graham points out that poor outcomes often result not from bad luck, but from management decisions that prioritize expansion, prestige, or short-term appearance over shareholder protection. Investors must remain skeptical of management claims and evaluate actions rather than words. Across all four case histories, Graham emphasizes the importance of financial conservatism. Companies that maintained strong balance sheets, avoided excessive debt, and respected shareholder interests were far more likely to survive adverse conditions. Those that stretched for growth or relied on optimistic assumptions eventually failed. Graham also reinforces the concept of margin of safety. In each case, investors who paid high prices based on optimistic expectations had no protection when reality fell short. Conversely, conservative valuation and strong financial structures could have limited losses even in difficult circumstances. Another key takeaway is the danger of trend-based thinking. Investors often assume that favorable conditions will persist and that past success guarantees future performance. Graham shows that many failures occurred precisely because both management and investors extrapolated recent success too far. Importantly, Graham does not present these cases to encourage fear, but to promote intelligent skepticism. The intelligent investor accepts that mistakes and adverse events are inevitable and prepares accordingly through diversification, conservative valuation, and careful analysis. In summary, Chapter 17 demonstrates that investment failures are rarely mysterious. They usually follow recognizable patterns: excessive debt, misleading earnings, shareholder dilution, and overconfidence. By studying these cases, investors can learn to identify warning signs early and avoid repeating the same costly mistakes. Graham's message is direct and practical. Understanding how investments fail is just as important as knowing how they succeed. A comparison of 8 pairs of companies. In Chapter 18, Benjamin Graham uses 8 pairs of comparable companies to demonstrate how investor expectations and market pricing can lead to dramatically different investment outcomes. The purpose of this chapter is to reinforce a central theme of the book. Investment results depend more on price paid than on business quality or popularity. Each pair consists of companies operating in similar industries or with comparable characteristics. At the time of analysis, one company in each pair was generally viewed more favorably by the market, while the other was considered less attractive. Graham examines how these perceptions influenced stock prices and how they affected subsequent returns. Graham's analysis shows a consistent pattern. The companies that investors favored tended to trade at higher price-to-earnings ratios, reflecting optimistic expectations for future growth. These stocks were often described as high quality, well-managed, or industry leaders. In contrast, their paired counterparts were typically priced at lower multiples due to slower growth, temporary difficulties, or lack of excitement. The key insight is that market optimism is already embedded in price. When investors pay high prices for favored companies, future success must exceed already optimistic assumptions just to justify the valuation. Any disappointment, even minor, leads to poor investment performance. Meanwhile, companies priced modestly require only average results to produce satisfactory returns. Graham emphasizes that this does not mean inferior companies are better investments by default. Rather, it means that valuation differences often outweigh business differences. A slightly weaker business purchased at a low price can outperform a superior business purchased at an excessive price. Another important lesson in this chapter is the danger of reputation-based investing. Investors often rely on brand recognition, management prestige, or past success when making decisions. Graham demonstrates that these qualitative factors, while not meaningless, are frequently overvalued by the market. Graham also reinforces the concept of reversion to the mean. Growth rates, profit margins, and competitive advantages tend to normalize over time. Companies that are priced for continued exceptional performance face a high hurdle, while companies priced pessimistically often benefit when conditions stabilize. The chapter further illustrates the importance of comparative analysis. Evaluating companies in isolation can hide mispricing. By comparing similar businesses side by side using consistent criteria, investors can more clearly identify when the market's expectations have become unbalanced. Graham does not suggest that investors should automatically choose the cheaper stock in every comparison. Instead, he encourages skepticism toward high valuations and confidence toward reasonable prices. The intelligent investor seeks a margin of safety, not perfection. A recurring theme across all 8 comparisons is that investor psychology plays a dominant role in pricing. Popular stocks attract more buyers, pushing prices higher, while unpopular stocks are neglected, creating potential value. Over time, these emotional extremes tend to correct. In summary, Chapter 18 reinforces Graham's message that investment success is driven by valuation discipline. Superior companies do not guarantee superior returns, and average companies do not doom investors to poor outcomes. What matters most is the relationship between price, expectations, and underlying fundamentals. Graham's conclusion is practical and consistent. Intelligent investors compare, question, and resist the urge to pay premium prices for popularity. Shareholders and management's dividend policy. In Chapter 19, Benjamin Graham examines the relationship between shareholders and corporate management, focusing specifically on dividend policy and how management decisions affect shareholder value. This chapter addresses a critical but often overlooked issue: whether management acts primarily in the interest of shareholders or prioritizes expansion, control, and internal preferences. Graham begins by emphasizing that shareholders are the owners of the business, while management serves as their representative. In theory, management decisions should aim to maximize shareholder value. In practice, however, Graham observes that management often retains earnings rather than distributing them as dividends, without clearly demonstrating that reinvested profits will generate adequate returns. A central argument in this chapter is that retained earnings are not automatically beneficial. Graham explains that when a company keeps profits instead of paying dividends, shareholders are effectively reinvesting their money back into the business. This reinvestment is only justified if management can earn returns that are at least equal to what shareholders could earn elsewhere at comparable risk. Graham introduces the concept of dividend justification. Management should be able to show that each dollar retained has resulted in a corresponding increase in the company's market value or earning power. If retained earnings do not translate into higher value, shareholders would have been better off receiving dividends and reallocating capital themselves. Another important issue Graham discusses is management control. Retaining earnings increases the size of the company and strengthens management's control, even if reinvestment opportunities are mediocre. Graham argues that this creates a conflict of interest. Management may prefer growth for prestige and security, while shareholders may prefer income and efficient capital allocation. Graham also criticizes the common argument that dividend payments are inefficient because shareholders can simply sell shares if they want income. He points out that selling shares reduces ownership and may trigger unfavorable market timing or tax consequences. Dividends provide a direct and transparent return on investment without requiring shareholders to reduce their stake. The chapter also addresses stock dividends and stock splits, which Graham views with skepticism. While these actions may increase liquidity or improve marketability, they do not create real value by themselves. Graham warns investors not to confuse cosmetic changes with genuine economic benefits. Graham encourages shareholders to be active and informed rather than passive. Investors should evaluate management's capital allocation record and support dividend policies that reflect shareholder interests. Blind trust in management, especially when results are poor, exposes investors to long-term underperformance. Another key takeaway is Graham's emphasis on measurable outcomes. Management claims about long-term growth and strategic reinvestment should be judged based on results, not intentions. Shareholders should focus on return on retained earnings, not on growth narratives. In summary, Chapter 19 teaches that dividend policy is a test of management's discipline and alignment with shareholders. Retaining earnings is acceptable only when it creates demonstrable value. Otherwise, dividends are the more honest and efficient use of profits. Graham's message is direct. Shareholders should demand accountability for retained earnings, and intelligent investors favor companies where management treats capital as a responsibility, not a privilege. Margin of safety as the central concept of investment. Chapter 20 is the philosophical and practical conclusion of The Intelligent Investor. In this chapter, Benjamin Graham introduces and reinforces what he considers the single most important principle in Investing, the margin of safety. Graham makes it clear that all intelligent investment strategies ultimately depend on this concept. Graham defines the margin of safety as the difference between a security's intrinsic value and its market price. When investors buy securities at prices significantly below their conservative estimate of value, they create a buffer that protects them from errors in analysis, unexpected business problems, and adverse economic conditions. The core purpose of the margin of safety is risk reduction, not return maximization. Graham emphasizes that investing is an uncertain activity by nature. Since future earnings, interest rates, and economic conditions cannot be predicted with precision, investors must build safety directly into the price they pay. Graham explains that the margin of safety operates on multiple levels. At the individual security level, it comes from buying assets at low valuations relative to earnings, assets, or cash flow. At the portfolio level, it is reinforced through diversification, which reduces the impact of any single mistake. Both are essential components of intelligent investing. A key point in this chapter is Graham's rejection of precision in valuation. He argues that intrinsic value is not a fixed number, but a range. Because valuation is inherently imprecise, investors who pay prices close to estimated value leave themselves vulnerable. A wide margin of safety compensates for this uncertainty. Graham contrasts intelligent investing with speculation by highlighting the absence of a margin of safety in speculative behavior. Speculators rely on favorable future developments, optimistic assumptions, or continued market enthusiasm. If these expectations fail, there is little or no protection against loss. Intelligent investors, by contrast, assume that mistakes and setbacks will occur and prepare for them. The chapter also reinforces Graham's emphasis on discipline and temperament. The margin of safety often requires buying when prices are depressed and sentiment is negative, and avoiding purchases when optimism is widespread. This behavior is psychologically difficult, which is why many investors abandon the principle during bull markets. Graham makes it clear that the margin of safety does not guarantee success in every investment. Some investments will still fail. However, when applied consistently across a diversified portfolio, the margin of safety greatly improves long-term outcomes by limiting losses and allowing gains to compound. Another important idea is that no amount of intelligence, forecasting skill, or confidence can replace the margin of safety. Graham argues that investors who rely on superior insight rather than price discipline are engaging in speculation, regardless of how sophisticated their analysis appears. In concluding the book, Graham ties together all previous chapters: asset allocation, stock selection, earnings analysis, dividend policy, and market behavior all serve one ultimate goal: to invest with a margin of safety. In summary, Chapter 20 delivers Graham's final and most enduring lesson. Intelligent investing is not about predicting the future or outperforming others. It is about structuring decisions so that even when things go wrong, the outcome is still acceptable. Graham's conclusion is unequivocal: the margin of safety is the foundation of all sound investment decisions. The Intelligent Investor is not a book about beating the market, predicting prices, or finding the next winning stock. It is a book about avoiding the mistakes that destroy long-term wealth. Across 20 chapters, Benjamin Graham builds a complete framework for rational investing based on discipline, valuation, and risk control. The foundation of the book is the distinction between investment and speculation. Investment requires thorough analysis, safety of principle, and reasonable return. Anything else is speculation, regardless of how popular or sophisticated it appears. Graham's message is clear: most investors underperform not because markets are unfair, but because they behave like speculators while believing they are investors. A central theme throughout the book is behavioral discipline. Graham repeatedly emphasizes that the investor's biggest enemy is not inflation, recessions, or market volatility. It is emotional decision-making. Fear and greed cause investors to buy high, sell low, chase trends, and abandon sound principles at the worst possible times. Graham introduces two investor types: the defensive investor, who prioritizes safety and simplicity, and the enterprising investor, who seeks higher returns through effort and analysis. Both can succeed, but only if they operate within clear limits and remain consistent with their chosen approach. Trying to mix strategies or switch styles based on market conditions leads to poor outcomes. The book places strong emphasis on valuation. Business quality alone does not determine investment success. The price paid relative to earnings, assets, and financial strength is what ultimately drives returns. Graham repeatedly demonstrates that overpaying for growth and popularity is one of the most common and damaging mistakes investors make. Another critical lesson is skepticism toward forecasts, experts, and complex products. Graham shows that professional managers, analysts, advisors, and innovative securities often fail to protect investors' interests. Intelligence in investing comes not from complexity, but from clarity and conservatism. The psychological framework of Mr. Market teaches investors how to view volatility as an opportunity rather than a threat. Market prices should serve the investor, not instruct them. Price fluctuations are useful only when they allow investors to buy below value or sell above value. All of these ideas lead to Graham's final and most important principle, the margin of safety. By demanding a meaningful gap between price and intrinsic value, investors protect themselves against uncertainty, errors, and bad luck. The margin of safety is not a strategy. It is the foundation of every sound investment decision. In essence, the intelligent investor teaches that long-term success comes from doing fewer things, more carefully and with greater emotional control. If this summary helped you understand investing more clearly, like the video, subscribe to the channel, and turn on notifications for more breakdowns of timeless financial books. Comment below, are you a defensive investor or an enterprising investor, and why? And remember, the goal isn't to be smarter than the market. The goal is to be more disciplined than your emotions. See you in the next video.